Hello, everybody. It is such a beautiful evening here in Los Angeles, California. I'm welcoming one of our joining with us for this week's edition of Wealth Wisdom, and we have a special guest lecturer and presenter, Jesus Reyes. But let me say just a couple of things first. What an exciting period of several days we've enjoyed at ByDzyne. It was only a few days ago that for the first ever historical event at ByDzyne, we hosted our first ever luxury home and supercar bonus event in the beautiful hills above Malibu, California. One of the most stunning and beautiful pieces of real estate anywhere in the United States. And we had some of our key leaders that were the first recipients, if you can imagine, of supercars and luxury homes. We've already made those presentations, and what a great opportunity that was to really look into some magic and the real lifestyle choices made possible by everyone here at ByDzyne. And then just a couple of nights ago, in our phenomenal Super Saturday event that we named Need for Speed, what a great opportunity that was to recognize our men and women brand ambassadors from so many different parts of the world that really have accomplished some great things. What a great period of momentum we are in right now. The growth curve that is coming to ByDzyne is here right now. We're all in the perfect place at the perfect time. And now tonight, to get to have the opportunity to come together and learn some additional wisdom, golden nuggets, inspiring thoughts of understanding about our Forex education and Forex training product, Smart Market Academy, presented by MTI. And tonight, we have the great privilege of having an outstanding currency strategist, Jesus Reyes, who is going to be our expert presenter. Now, it's not every single week that I have the opportunity to use a quote that actually comes from our expert, but I'm going to take advantage of something that was shared with me today. And Jesus, I hope you're the one that wrote this, because I'm giving you full credit for it right now. Long-term or short-term, there are success strategies you can use to plan for your future. Well, with that kind of wisdom, that kind of experience, a great background, not only in Forex education, but in banking and corporate finance, because at the end of the day, Jesus also has a master's degree in banking, corporate, and finance, and also has a legal background. So, Jesus, it's my privilege to welcome you officially again to our Wealth Wisdom call tonight, and I'll turn the mic over to you right now.
Thank you very much, Dave. I appreciate the kind words and the warm welcome. And it's truly an honor of being here and having the opportunity of talking to you all. So good evening to you and all, wherever you might be joining from. And yes, I mean, through trading, through learning how to analyze the market, there is a wealth of opportunity to create and generate income, not only for today, but for tomorrow, not only for us, but for those who come after us. And the opportunity that I have managed to have access to through MTI, learning first as a student and then having the opportunity of becoming an analyst and using everything that I had learned before I joined MTI on an academic background has really useful, and the opportunities at MTI to offer this knowledge and share it with you all and have the opportunity of teach as I was taught is really amazing. And you, many of you through the Academy, through ByDzyne, through Smart Market Academy have had the opportunity of learning about the Forex market, of learning of the vast opportunity, the versatility that it offers, and the technical elements that we use to take advantage of a market that opens Sunday, closes Friday, and throughout that week is open for us. We can, whenever we have the chance, we can sit, look at the market, analyze trades, use the education within Smart Market Academy, use the different tools that we have like Smart Gauge, just to name a few, use the classes, the lessons, not only on technical analysis, but also on mindset that are offered throughout with FX Chief, with FX Big Dog, and all of the analysts that work at MTI to identify the market, to take advantage. But one very key element that we always need to have in mind is not only using the education to identify potential opportunities, but also learning how to use this information in the sense of not only identifying opportunities, but using the capital that we have in a way that will allow us to profit long term, to last within the Forex industry, within the investment industry, because there is always risk implied. So risk management, equity management is going to be key. It's not only learning how to identify the market, but how to execute the trades, what kind of lot sizes we need to be using. And all of this needs to be established beforehand. We need to have a trading plan. Once we have that opportunity, what type of lot size are we going to use? How much should we risk per trade? Once we have executed several trades, up to which point should we continue to add positions, whether it is on that same currency or any other that we are analyzing along with the trades that we already have open. So all of this comes together to establish a trading plan that will allow us to last within the trading plan. This is a long-term setup. So one of the key elements that we need to keep in mind is learning how to properly plan a trade. So let's see if I can share my screen for a moment. All right. Please let me know in a message if my charts are visible. Just want to make sure it all seems to be working okay. Perfect. All right. Now, properly planning a trade. Before we enter the market, we need to know why we're getting in, where we're getting in, where we anticipate the market to go to, and how much we're willing to risk. One of the beautiful things is using our stops to limit the amount of risk that we're willing to take on a particular trade. So whether we're buying or we are selling, let's say that we're selling, we have, through this platform, through our education, the knowledge to know that we need to know where the stop is going to be placed, when, and why we're taking an entry at a certain level, and to where it is that we want to hold that trade. All right, this will allow us to maintain control of our trades and properly manage the risk that trade and any trade, as we are all moving and talking about investment and finance, entails. So we have to know when and where we're going to place our stop. This will allow us to control how much we are willing to risk on that given trade. We need to know when and where we are going to take entry into the position. All of this through the analysis, through the use of resistance, support, Fibonacci's, and retracement level push zones, and all of these concepts that many of you have now become familiarized with. This allows us to properly plan the trade, know when and where we're getting in. And of course, we're in it to gain pips. Pips translates into money. We also need to know where we are going to be limiting out. So each trade that we execute, with the exception of advanced strategies that some of you may have been exposed to or may be learning, we always need to have 3 points clear: where we're getting in, at which point we're looking to admit that trade is not going to be going our way and we're going to get out from that position, and to where we are projecting that trade to go and where we're going to take our profit and get ready for a new opportunity for another trade within that same move. So every entry will have 3: an entry, a stop, and a limit. And if our entry is a sell order, our stop and our limit will be a buy order. And vice versa, is where if we're buying the market, our entry is going to be a buy, our exit and our limits are going to be sell positions. Now, through this, we also need to keep in mind something called within the education, the formula for the preservation of capital. All right. If we are working with, there's a raw material that we need to use. In this case, it's money. If you're building tables, chairs, you wood. If you're going to be cooking, you need your ingredients. If you're going to trade, you need money. And we need to make sure that we make the proper use of our money. We need to establish a trading methodology that allows us to take care of that money in order to always have that material with which to produce more trades. And through those trades, more pips, and through those trades, through those pips, more opportunity to increase our trade positions. So we want to win all of our trades. We want to have 100% success rate. But we know as there is risk within trading, we don't need to win them all to be successful. And here is something that is called risk-reward ratio. Risk-reward ratio, I'm sure that many of you are familiarized with the term, and it's how much I am willing to risk and in order to go for a certain amount of reward. At the very, very, very minimum, you're going to move for a 1-to-1 risk versus reward. That means that if you are risking 50, you're going after 50. You're not going to be risking 50 to go after 30. Now, here's the thing. When you go for a 1-to-1 risk-reward ratio, you need to be right at least 50% of the time to break even at the end of each 10 trades. So for example, if I am risking 50 pips, 50 pip risk, and times 5 trades that I lost, that will be a 250 pip loss, total loss. Now, if I go then and I win 50 pip risk, 50 pip reward, and I won 5 trades, then at the end of those 5 trades, I have a total win, total profit of 250. So at the end of those 10 trades, I broke even. Right? So as I begin to tweak my risk-reward ratio, going for more reward for the same amount of risk, then that percentage is going to change. So if I move from a 1-to-1 to a 1-to-1.5, let's leave that one here, 1-to-1, and you need a 50% success rate to break even. All right. If you increase that to a 1 to 1.5, and let's use proper. If you use here and you go for a 1 to 1.5, then you need to be right 4 out of 10. So a 40% success rate is now going to leave you at break even. But if we increase that risk reward let's remove this, to a 1 to 2, then that same 40% success rate is now leaving us at profit. So I can be right 6 out of 10 times with a 1 to 2 risk reward, and I'm already making money at the end of each 10 trades. And if that moves that a little bit further to a 1 to 3, then with a 30% success rate, I am in profit. So by this, you only need to be right 3 out of 10 times. Now, this doesn't mean I'm going to settle to with being right 3 times out of every 10 trades that I take, because when you combine this with a proven entry strategy and trading methodology as the one that you find throughout Smart Market Academy, you're going to be able to combine a reward ratio of a 1 to 3 or a 1 to 2 with a trading strategy that has 70, 60, 80% success rate. So do those numbers. That is consistent profit month over month. That doesn't discard the loss, because trading has risk, it's inherent to it. But through this combination that you'll find through the education, you'll be able to establish a plan to success, a plan to consistent gains. And through those consistent gains, if you're now trading 1, 2, 3 micro lots, that's going to build up to 5, that's going to build up to 7. Soon you're going to be at a standard lot position where for every pip you're making $10. A 100% pip trade is going to be $1,000 to your account. And with that and a trading plan to go 500 pips a week, then do the math. That's already 5,000 a week that you're going to be making. Then you go, as you went from 3 mini micro lots to 5 micro lots to 1 standard lot, you're going to then go to 1 standard lot, 1.5, 2 standard lots, and so on. And those same 500 pips will turn to 5 to 10 to $15,000 a month. That's why I mentioned at the beginning that through trading, you can create generational wealth. It takes time, it takes patience, it requires consistency. Consistency and all of this is going to be key, because if I'm going to select a risk reward ratio as part of my trading plan, I need to stick to that 3-6 months to make sure that that 1 to 2 works for me. If it doesn't, then I'll try with 1, 2, 3. But after a period where I have had the opportunity of trading 200, 300, 400 times using that risk reward ratio to make sure that it works. It works based on your risk aversion. It works based on the time that you have to trade. Make sure that it works for you. We wait for the market to give us the scenarios. We need to make sure that everything adapts to what we're looking for. Now, it is not only about the risk-reward ratios that we select as part of our trading plan. Another way of managing our risk is establishing what is called a risk per trade. Risk management is how much to risk per trade. That means this is going to be set in a percent amount per trade in regards to our trading capital. So we need to know from every position that we take how much that represents from our available margin to trade. All right. Now that will vary. It's not the same for someone who is an individual trader, someone who is working with their own money, with their capital, in regards to someone who is a money manager. A money manager is a person who captures capital from different clients, customers, investors, and trades it for them and reports their gains. And from that gain, they keep some money, and that's their living. Individual traders, which is likely the majority of us in the room, have the opportunity of being a little bit more aggressive when it comes to capital. However, successful traders risk no more than 2 to 5% of their margin account on a single trade. All right, so let's bring that over here. As individual traders, we should not be risking more than 2 to 5% of our margin account on a single trade. And again, keeping an eye out for what this part right here, a single trade, because at first we are likely going to be starting with one currency pair, one of the most popular ones being the euro dollar. So I'm going to trade one position on the euro dollar. I'm going to wait for that one to be limited out. Then I look for another setup in a high probability scenario, and I go for another trade. But there will come a moment where you'll probably, within that same currency, will be adding to your positions, or you'll start to widen let's say your portfolio within the Forex currency pairs available, and you'll be trading euro dollar, pound dollar, or any other given pair that we have access to, or that you decide to analyze and trade. So we need to make sure that as we add all of those positions that we have open, that we do not over leverage your account, that we don't put us in a position of total risk that could have a strong impact in the event that the trade goes against us. All right, so that means that we need to make sure that we are using a lot size that will allow us to survive a streak of losses and still be in a position to use another trade with that same lot size. So to set it somehow, you need to be able to use a lot size that if you lose 15 or 20 trades in a single streak, that 21st trade needs to be able to be placed with that same lot size. Right? As I read once, if you are in bed and you can't sleep because you have an open position, then you're probably not using the proper lot size. So keep that in mind. Proper risk-reward ratios, proper risk management, knowing where you're entering and why, where your stop is and why, where your limit is and why. Now, when we trade, we have already learned throughout the different segments that the market moves in waves, and it moves forming A, B, C, D sequences. And we focus on trading the movement from the C to the D. Right? For those of you who have gone through different classes, you know that this C to D zone is known as the push zone. That's the part of the swing that completes the sequence and where we find opportunity of about 80% chance, that has about an 80% chance of going our way. And what are the most common tools that we use, because it has proven to have the ability of measuring almost to the pip how the market moves, is the fibs. And as the fib is used to measure that ABCD sequence, measuring the retracement to project that extension, we also learn where to place our stop, where the safest place for our stop will be. Now, the safest place for the stop will be beyond the A. In this case, I have a down AB, but if the case were of an up AB, swing, it would be below the A. So where's the safest place for the stop? It will be beyond the A. Why? Because on the way down, that capital A is my most recent level of major resistance, and my B is my most recent level of major support. And one thing that we learned from the market, one thing is that there are no absolutes. But one of the absolutes that you can take is, that could be an exception to that, is that the market will always do what it wants to do. The market will always be right. We need to allow the market room to move. We need to leave the market room to set and complete the technical sequence. So the safest place will be beyond the A, because these two major levels, one for support and one for resistance, if the market takes out either one of them, there is a track record of it continuing to move in that direction. So when I place my stop beyond it, I allow the market enough room to set and move in the direction of the target. So whenever we place our stop outside the AB boundary, whenever we place our stop outside the AB boundary, we decrease the probabilities of being stopped out by 80%. By placing a protective stop loss order outside the AB boundary and beyond the A, we decrease the percentage of getting stopped out before the market moves our way by almost 80%. Again, using methodology, MTI over 25, 30 years of experience has learned and established that when we leave our stop beyond the A, we have a better chance of seeing the market go our way, because unless the A is taken, that swing will hold, and the market has about an 80% chance of completing that B sequence. Oops, where did I go with it? Okay, here it is. Now, depending on the strategy that we use, depending on the time frames that we're using, the stop will be placed closer or farther from that A. All right, so when we're trading and taking entries on a 1 to 2 hour, a 2 hour or larger time frames, we need to place our stop 20 pips, to 20 to 30 pips beyond when trading 2 hour time frames or larger. Now, when we are trading 1 hour time frames or below, we can use 10 to 15 minute time, 10 to 15 pips distance beyond the A. So the larger the time frames, the larger the stop. But also remember, the larger the time frames, the more the amounts of pips that we are going after throughout that position. The greater the amounts of pips that we'll gain. Remember, pips translates into money. Money allows us to then go for more trades, with a larger lot size, and that means that the same amount of pips will translate every time into more and more money. And that's what we're trading for. That's what we're investing for. We want to grow not only in knowledge, but also in pips, and pips translates into money. But the fact that I'm talking about money, and I know we invest with that purpose, doesn't mean that we should plan our trade based on money. We always need to do so based on pips, because again, 10 pips at 100 pips a week on a micro lot is one thing, but as we grow, it will be 100 a week, 1,000 a week, 10,000 a week, and so on. Now, things to always keep in mind. When we trade, when we analyze the market, we look for those opportunities. We identify a good scenario as we know where and when we're going to be placing, where and why we're going to be placing our stop beyond the A, when and where and why we're going to be placing our entry, and where and why we're going to be placing our limit. We need to check how much of a lot, how much of a distance that is. And whenever our stop, regardless of how good the technical scenario presents, if the stop is too far away, if it means too much of a risk for me to take, if I plan on working with a 1% risk per trade, and when I calculate my distance between my entry and my stop, my risk would be 1.5, no matter how good it looks, we need to leave that one alone. There are over 28 currency pairs that we analyze through our on-demand sessions, through the advanced strategy sessions that you go, like the ones that you learned with, that Gary hosts. You'll see that even if the technical alignment is good, if the risk does not align with your account, we need to learn to leave that one and look for another trade. All right. That is also part of managing our equity, of managing our risk. Part of the technical analysis invites us to two things. One, the patience of waiting for the market to come to you, waiting for that scenario to be there. And secondly, and trusting the education, trusting the trading methodology, have the determination of executing the trade when it sets, as long as it complies with our trading plan. We need to be true to our trading plan, and in the measure that we are, we'll see the profit and we'll see sustained growth, which is what anyone looks for when trading, when investing, when putting in your money. You want to grow, but you want that to be sustained throughout time. Now, there is a strategy, equity management-wise, that allows us to grow and allows us to take advantage of long-term movements, making it more efficient pip-wise, because, and this is something I am going to need some space for, and I think that many of you could take advantage of. Now, as you've gone through the analysis, you've seen that we start with a larger time frame, then we move to the smaller time frame until we reach the one where the trade is going to be executed. So I want to stick to two in this case, the daily and the 2 hour. Now imagine that this swing that we're seeing here is a daily swing. This is a daily 80 boundary. And that we have identified that the market is getting ready to move from the C to the D. All right, so when we go over, if this is my daily swing, that on a smaller time frame is going to be comprised by a series of smaller, and let's make sure that this one is in a different color. So on a 2 hour, this is going to be a series of down A, B, C, Ds, down A, B, C, Ds, that the 2 hour is going to form and complete until that larger time frame sequence has been achieved. So if from here to here, I find that we have an overall let's actually measure that distance from here to here. This is giving us 1,816 pips. This is showing to hold 800 pips. C to D push. Right, I can take my trade here. I can take my position here to enter the market. I can place my stop beyond the A, and I can let the trade run for those 800 pips. Right, that will be a long-term move for 800 pips. However, I know now that each and every one of these moves, that this overall move will be comprised by similar A, B, C, D sequences, but on a smaller scale on my 2-hour. So that means that this A to B, C to D, as the market goes from C to D, we're going to have one swing here on the 2-hour, followed by another swing on the 2-hour, followed by another swing, and so on until that larger time frame sequence has been achieved. So if I move to my smaller time frame, I get that first swing. I look for a similar cross like it did with this angle right here, but on my 2-hour. And I sell that smaller move. From here down to there. That then gave me 200 pips. Then what is it that I do? Remember, once that has been completed, I'm going to have a new down AB. I already have here 200 pips. I repeat that process over here, and I wait for the next C to D push. And as the market goes from that 618 to this, it becomes a 249 pip move. I get out, I look for another trade. I take my trade here, measure that move. Based on the depth of the pullback, I can project the extension. That will be another 2-hour C to D move. And in this case, that would go for 228 pips. And as I continue to repeat that process, I'm already here. This is 800 pips. We're basically halfway through, and we're over 600, almost 600 pips in profit. All right. And that is only one way of taking that overall 800 pips that we can have already running as a long-term position. And then we have this one through the smaller ABCDs and the smaller time frame, and sell the C to D, sell the C to D. And that is 800 pips on this position that we held for however long that one took. That would be more of an investment side. And this one is a more active trading. This one is giving us 200 pips one week, 200 pips the other week, 200 more pips the other week. So through that, we make that 800 pips ever more efficient, because through those smaller sequences that will comprise the larger, we're taking profit on the long-term move, and we're taking profit on the smaller moves that comprise that same long-term move. We just need to make sure, and that is where we talked about recently, about whether it is that we're trading several pairs or whether that was sticking to one, but adding positions, that we do not over leverage our account, that we don't have at a given time an amount of trades which risks added puts us in a over leveraging position. That means having 10% of your total of your risk of your account at risk, having 8% of your account at risk. You want to make sure that you're around 5%. Okay? And through that, we can speed up our growth. We can speed up the process of going from 1 micro to 2 to 5 to 1 mini to 5 minis to 7 minis to 1 standard in a shorter term, being aggressive but with a controlled risk. Using the technicals, using sound equity management, knowing when and why we're entering the market, where we're placing our stop, and where we're going to be taking profit. So this is how equity management and risk-reward ratios help us grow. This is all the elements that you need to make sure that comprise your trading plan in order to ensure sustained long-term growth. That doesn't mean that you need to wait 10 years to be profitable. You don't need to wait 5 years to be profitable. You just need to make sure that you're using trading strategies and methodologies as those contained in the education offered to you through Smart Market Academy and combine them to your benefit. Now, another way that we can go through this is called canceling and replacing your stop. If you say, well, Jesus, I like that, it looks good. I want to get comfortable to the point that I can do that, having one long-term position and several others that are adding and allow me to get quicker. Or I like that the long-term part, but I want to make sure that I'm protecting the capital as the market moves my way. We can cancel and replace our stop. Now, initially, let's say that my position is up here, all right? And the market starts to move my way. I end the market right about here. And what does the market do? It takes out that low. Takes out the low, forms a lower low, pulls back. I set an alert for when the market breaks that angle. And what am I going to do? I'm going to bring my entry over that high. What will the market do from here? It crosses, takes out that low, pulls back, and as it pulls back, I take that same alert and I move it over. Once the market makes its way down, I'll take my stop and cancel it to above the most recent high. The market will drop, it will pull back, I take that same alert and I place it over here, and once the market makes its way through it, I am going to cancel and replace my stop and placing it above the most recent high. And I continue to apply that same process. Now let's follow the proper steps. First, the market moves. I wait for the market to come to me. And once the market complies with the technical requirements, I'll have the determination of executing the trade, or in this case, moving and canceling and replacing my stop as the market moves along the way. So what was an original risk no longer exists. And now all of this is protected gains. These gains are protected as the market moves my way and I cancel and replace my stop. Now, what will happen eventually is that the market will either complete the sequence and then pull back as it moves into a new swing, or it could give us a deeper corrective movement before it continues to drop. But since I have been canceling and replacing my stop I may be given back some of my gains, but my capital is protected, and a great part of that move, of the gains that I have been accumulated, are already in my account. The market will hit my stop, I'll give back some of my gains, but the great chunk of it is already mine. So these are some of the different ways that we can use this equity management risk-reward ratios as part of our plan, protect our capital, accelerate our growth without risking, without risking more than we should, or risking responsibly, having a controlled risk of our trades. Any questions so far? All right, so remember, always know when and why you're entering a trade. Never trade without a stop. The safest place for our stop will be beyond the A. If the technical element complies with everything, but the stop needs to be placed at a position that is too much of a risk, we need to stand aside, wait for it to give us a setup that aligns with everything, then we can execute. Know how much you're willing to risk per trade. 1%, 0.5%, 1.5, not more than 2 per trade. Depending on how you want to go about it, the smaller the amount, the smaller the risk per trade, the more amount of trades that you'll be able to have at a given time. So the example that we went through before about the different lot size, the different positions on the way down, in addition to that long-term C to D move, is the type of scenario where you'll probably want to use a smaller lot size, but remember that you're doing so because you're adding to that position, or you're going to have potentially more than one trade running at a given time. And you may do that with one or more pairs. So always make sure that you establish, based on the entry static that you want to follow, a lot size that allows you to do so in a safe manner. Again, sustained growth requires consistent risk management and risk-reward ratios. And when it comes to risk-reward, 1 to 2 is a good number to go. If you're a scalper, then maybe 1 to 1, 1 to 1.5. But remember that in this case, you need at least 40% with a 1 to 1.5 to break even, and 50% success rate. I mean, with a 1 to 1.5, 40% success rate to break even. With a 1 to 1, 50% success rate to break even. With a 1 to 2, 40% success rate, and you're making money. With a 1 to 3, 30% success rate, and you're making money at the end of each 10 trades.
Jesus, can I ask you a question?
Yes, of course.
So I've been hearing you talk about risk and reward. Would you agree with me if I said that learning how to take educated risks, not wild risks, but educated risks, is one of the keys to experiencing success in the Forex markets?
Absolutely, absolutely, because when investing, when trading, there is risk involved, but having the education act, the one provided through the Smart Market Academy, will give you the tools to make, as you say, educated risks. Take on educated risk, controlled risk that will allow you to grow. If it doesn't go in our favor, the risk will be controlled. But once it does and we're able to replicate that process, success will follow, and sustained and continued, which will allow us to grow.
Part of the reason why I asked the question is that I believe that the very educational opportunities that are available through MTI and all of you experts is in fact to help our brand ambassadors to be able to become those educated risk takers so that they will actually see value in the SMA product that they spend their money on to join and become a part of ByDzyne. So I was just emphasizing that point with you because I heard that coming loud and clear through the messaging that you've given us tonight.
Excellent, excellent. Yes, that's absolutely it.
Well, we are coming very close to the end of our program. Timing. Any information that you wanted to share before we officially bring this episode of Wealth Wisdom to a conclusion?
I'm sorry, it got a bit interrupted.
Oh, what I said is we're coming very close to the time now where we are going to need to conclude our Wealth Wisdom segment, because at the top of the hour, we have our next episode of Mind Movers. So I just wanted to ask you if you had any final words that you wanted to leave with our brand ambassadors, or if you had concluded most of the things that you wanted to say.
No, that would be, I concluded basically everything that I wanted to share. I just wanted to make sure that everyone knows that we have different ways of growing sustainedly in a sustained and quick manner. Doesn't need to be that much of a long term to go from where we are to where we want to be. We just need to make sure that we do not over trade our account, and we use the education and the tools that we have to apply those educated risks.
Well, Jesus, thank you very, very much. We're delighted that you have spent these moments with us tonight. And I know I can speak on behalf of all of our brand ambassadors around the world that they're grateful, and I'm grateful for the information that you have shared with us tonight. So we appreciate your time. We appreciate your preparation, and we'll be looking forward to having you be with us again in a few weeks.
Looking forward to that, and thank you very much for the opportunity of sharing with you all.